Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my good friend Adrian Day. He is the founder of Adrian Day Asset Management. Welcome back, sir.
Well, thank you for having me again, Ivan.
Yeah, it's always nice talking to you about the markets and everything that's going to develop with Jerome Powell. We'll see. We'll see what his next moves are. It's super interesting. I think one of the biggest questions out there right now, Adrian, is have we made it through the worst of the banking crisis? What's concerning you right now in the markets?
No, I don't think we've seen the worst of the banking crisis or financial crisis more broadly, nor the worst of the economy by any means. I think, frankly, people who are expecting a no landing and think that all the problems are behind us are optimistic, shall we say. I had another word in mind, but let's be polite. We've talked about this before from a macro point, if you stand back a little bit, not on a day-to-day, week-to-week basis, but just stand back a little bit, the message is really the same as it was last time, Ivan. But we're seeing things come into focus now. We must never forget that monetary policy works with long and variable lags. Milton Friedman said that. And, a lot of economists think it's 18 to 24 months after rates go positive. We've only had a year, we've had less than a year and a quarter of increasing interest rates.
Right.
That's not a long time.
No.
We've been in positive, we've had positive real rates for what, 3 months now? So these things take a long time to work through the economy, and they take a particularly long time in the current circumstance, when we had ultra low rates, excessively low rates for so long, meaning people, households, corporations had the ability to get their finances in a better shape.
Right.
So corporations, for example, most companies, took advantage of the low interest rates to term out their debt. And so if you look at corporate America in general, the amount of debt that had to be rolled over in the last 12 months as the Fed was raising rates was really pretty small compared with the balance sheets of corporations. That's going to, as each month passes, more and more companies have to refinance, and they're not refinancing. Let's just say it's a small business that used to get a loan, 5 years ago, 3 years ago, they could have got a loan at 7%. Now they have to refinance at 11%. Huge difference. And for AAA companies, the gap is, the difference is even wider.
Right.
In percentage terms. Similarly, households, virtually every household in America refinanced their mortgage. They didn't all get the bottom, of course, but they all refinanced it. And if they could have afforded the 8% mortgage when they took it on, and they refinanced to 3.5, well, that gives them excess money.
Yeah, absolutely.
And so the point I'm making is that you always have these long and variable lags in monetary policy, but now you have a particularly long runway because people started off, debt levels are enormous.
Right.
But people started off with without the problem of suddenly having to refinance at a much higher level. But we're seeing it not just in the US, but in Europe in particular. We had a whole slew of economic data from Europe this week, all of it negative. You look at the US, and anecdotally or factually, you see that the Bureau of Labor Statistics, they revised downwards the March number of workers on the payrolls by over 300,000.
Wow.
So things aren't even as good as we were told they were.
Right.
The point I'm making is that we are heading inevitably, inexorably towards a recession in the US. I don't see any way to avoid it.
Yeah, you nailed it, Adrian. And you look even in Canada, a lot of their mortgages, you can only do 3 or 5 year fixed. And a lot of the fixed rates right now, even in the US, like some of them are hitting 8%, mortgages for on their mortgages. So what happens, like what you said, when it actually starts kicking in, and when all these banks start having it's just really crazy what's going to happen in the next 6 to 12 months. And another big
Sure.
question is what's in the community. We want to know about gold and silver. Where do you think it's going as everything develops in the next 6 months? Where do you think gold and silver are heading?
Yeah, my basic approach to gold for the last 18 months has been gold and silver will take off, because silver really acts like it is a monetary metal,
Right.
but it acts like a monetary metal primarily, notwithstanding the difference in demand, the difference in supply characteristics from gold.
Right.
We talked about that before. But when you look at when you look at the price of silver, it really does act like a monetary metal. So I've said for 18 months, gold and silver will really take off when the market believes, comes to realize, appreciates, whatever you want, when the market believes that the Fed will stop tightening before they have killed inflation, right? And we are very, very close to that point now. And, we saw end of last year, even though inflation rates were coming down, gold went up because there was a lot of talk about a pivot.
Right.
Didn't happen, and so gold retreated. So gold has been down for except today, has been down for the last several months because the market is listening to what Powell says. They raised rates in July. I don't think that was a surprise, but they're listening to what Powell says. The dot plot is calling for even 2 more rate hikes before the end of the year.
Wow.
And the market is listening to that. Now, with the weaker economic data, the market is realizing that we are very, very close to the point where the Fed is going to stop tightening, but they won't have killed inflation. And people say to me sometimes, well, if there's a recession, that's going to cause inflation to come down, isn't it? Because, other things being equal, of course,
Right.
in a recession, there's less demand. So there's less demand, so prices come down. And the answer to that is yes. But that's looking at it in a very, very immediate and short term. If we have a recession, that only adds pressure on the Fed to ease, and at the very minimum to stop tightening, but probably to ease. And you only have to look back again. If we look at the 1970s as a roadmap, you only have to look back to 1974, 1975, very, very sharp recession in the US. Gold took it on the chin for about, 8 months? And then it exploded upwards afterwards because inflation was not killed. It was only subdued temporarily. We have not killed inflation.
So we're kind of, in my view, the same thing too. We're kind of in that similar stage as we're subduing inflation while the Fed is trying to subdue inflation. And then possibly within the next, let's say gold does take a hit when they initially do pivot, then you're saying just like the 70s, after 7-8 months, it took off, because that's what history shows.
Well, let me just, I don't want to leave a misunderstanding. If they pivot, which I'm not sure they will in the near term, but if they pivot, gold will take off.
Right.
I'm saying if there's a recession, gold will retreat. But it'll be short term, in my view.
Yeah.
And that's really what we need to watch. And of course, what Powell says on Friday at Jackson Hole is going to be telling. Now, he hasn't spoken yet, but you and I probably know what he's going to say. He's going to say fighting inflation is our #1 priority. We're very aware of the pain it causes people. We're going to be data dependent.
Same script.
What?
It's the same script he always
So we know what he's going to say. I would think if there's no surprise at Jackson Hole, that will be positive for gold.
Right. If there's no
Because they
crazy
really cut
surprises.
themselves, we know this, we've talked, a lot of people have talked about this. They've really boxed themselves into a corner, if you want, but they really are between a rock and a hard place. Powell, I mean, I don't excuse the Fed at all, and I don't excuse Powell. Powell, as well as before him, Yellen and Bernanke, they kept rates, well, they kept monetary policy far too easy for far too long. And you saw that when Powell came in, he tried to raise rates. And when the stock market said, we don't like it, he immediately pivoted.
Right.
And so he takes a lot of the blame for this. If it was right for the Fed to ease monetary policy dramatically and increase the size of the balance sheet in 2008, and I say if, because I don't think it was, but if it was, you cannot, I don't think anyone can dispute, but even if that was right, they kept monetary policy too easy for far too long. And we're now reaping the benefits. Reaping the benefits. We're now reaping the consequences, I should say.
Yeah, well, you see now, Adrian, that the debt servicing on the 32 trillion is north of like $1 trillion a year now, which is pretty insane. What happens when like the debt just won't, like they can't just rewind it? It's going to hit one day 40 trillion, and eventually in the next 10-15 years, if you stay on the same path, it'll be 50 trillion. So right now it's about $1 trillion a year, just the interest on the debt servicing of the 32 trillion. What happens in like 5-6 years? Like it's not sustainable, right?
Absolutely right. It's not sustainable. And this is the reason that Powell, this is the primary reason that Powell will be unable to do what Volcker did,
right?
Which is jack rates up to where they need to be to kill inflation. He can't do that because of the effect on the federal government budget and the federal government budget servicing. And the problem is, if you look at the US, you know this. I mean, I'm sure most of your listeners, even in Canada, they know this. But in the US, most of the spending is not discretionary. All of the Social Security spending, all of the Medicare, et cetera, all of the entitlements are outside of the annual budget. So when they come to discuss the annual budget, which Congress is going to do next month, they're looking at, what are they looking at? They're looking at defense, which very few people want to cut significantly, and most people want to increase. Biden wants to increase by sending billions to Ukraine. The Republicans always want to increase by giving the military new toys. So you've got the military, and then what else do you have? You have, the 100,000 grant to the lesbian dance theater of, upper Wisconsin or whatever. These are small amounts of money, small amounts. You and I could get in there and we could cut the budget. But in terms of the total budget, we're only talking, even if you include defense, we're only talking 30% of the budget. You can't cut the interest rate, but you pay on
the debt
without defaulting, of course.
Right.
So what are they going to do? They're going to have to print more money. It's Congress, the whole political class in the US refuses to look at entitlements.
Right.
They call it the third rail of US politics.
Yeah, exactly.
They refuse to look at it. But that has to be tackled in order to solve the budget problem. And of course, I don't want to sound like, someone, who's had a few pints in a pub and is just sprouting off. But at the time, I said, why doesn't the US government issue 100-year bonds? When Japan had negative rates, when Europe had negative rates, when the US economy was the strongest economy in the world, the US could have issued 100-year bonds at 2.5 or 3%.
Right.
I've talked to people, they say, yeah, that's what they could have sold them for. Why didn't they do that?
Why?
Because
Why?
it's so short-term oriented. They wanted to issue 6-month bills at 0.25% instead of 100-year at 2.5 or 3%. and it's
Wow.
just short-term foolishness.
Yeah, no, you absolutely nailed it. It's going to be pretty interesting to see what happens to everything, like what Fed does on Friday at Jackson Hole. So we'll be watching that closely. And we really want to thank you for coming down to Wall Street Silver and talking about everything. It's always a pleasure having you come down, Adrian. So thank you so much.
Well, thank you. But one last comment:
Yes, yes,
gold and silver stocks. I mean, I would
yes.
load up right now.
Yeah, because this is a perfect time.
Perfect time.
Yeah. Or do you have any names? Any or no?
I mean, I think among the major miners, Agnico is the best and very, very inexpensive. You know, among the silver companies, I mean, I like Fortuna.
Okay.
I like Pan American, and we both know, and everybody knows that they produce more gold than
Then
silver.
silver. Yeah, Pan American.
But they're still silver names, and a lot of the juniors and exploration companies are very, very compelling value in my mind.
Yeah, very interesting. We'll have you back on in the next month or 2 months to see what happens with everything with the mining stocks, with Powell and everything moving forward. So thank you so much, Adrian.
Well, thank you very much. Thank you for having me.
Talk to you soon.